Moves above or below the bands are not signals per se. As Bollinger puts it, moves that touch or exceed the bands are not signals, but rather, tags. On the face of it, a move to the upper band shows strength, while a sharp move to the lower band shows weakness. Momentum oscillators work much the same way. Overbought is not necessarily bullish. It takes strength to reach overbought levels, and overbought conditions can extend in a strong uptrend. Similarly, prices can walk the band with numerous touches during a strong uptrend. Think about it for a moment. The upper band is 2 standard deviations above the 20-period simple moving average. It takes a pretty strong price move to exceed this upper band. An upper band touch that occurs after a Bollinger Band confirmed W bottom would signal the start of an uptrend. Just as a strong uptrend produces numerous upper band tags, it is also common for prices to never reach the lower band during an uptrend. The 20-day SMA sometimes acts as support. In fact, dips below the 20-day SMA sometimes provide buying opportunities before the next tag of the upper band. Chart on the screen shows a stock with a surge and close above the upper band in mid-July. First, notice that this is a strong surge that broke above 2 resistance levels. A strong upward thrust is a sign of strength, not weakness. Trading turned flat in August and the 20-day SMA moved sideways. The Bollinger Bands narrowed, but the stock did not close below the lower band. Prices and the 20-day SMA turned up in September. Overall, the stock closed above the upper band at least 5 times over a 4-month period. The indicator window shows the 10-period Commodity Channel Index, or CCI. Dips below -100 are deemed oversold and moves back above -100 signal the start of an oversold bounce. Look at the green dotted line. The upper band tag and breakout started the uptrend. CCI then identified tradable pullbacks with dips below -100. This is an example of combining Bollinger Bands with a momentum oscillator for trading signals. Chart on the screen shows a stock with a walk down the lower band. The stock broke down in January with a support break and closed below the lower band. From mid-January until early May, the stock closed below the lower band at least 5 times. Notice that the stock did not close above the upper band once during this period. The support break and initial close below the lower band signaled a downtrend. As such, the 10-period Commodity Channel Index, or CCI, was used to identify short-term overbought situations. A move above +100 is overbought. A move back below +100 signals a resumption of the downtrend. This system triggered 2 good signals in early 2010. Bollinger Bands reflect direction with the 20-period SMA and volatility with the upper/lower bands. As such, they can be used to determine if prices are relatively high or low. According to John Bollinger, the bands should contain 88 to 89% of price action, which makes a move outside the bands significant. Technically, prices are relatively high when above the upper band and relatively low when below the lower band. However, relatively high should not be regarded as bearish or as a sell signal. Likewise, Relatively low should not be considered bullish or as a buy signal. Prices are high or low for a reason. As with other indicators, Bollinger Bands are not meant to be used as a standalone tool. Chartists should combine Bollinger Bands with basic trend analysis and other indicators for confirmation.